Good morning, everyone. I hope you all are well this morning. So, guys, let's see who all of you are here. So, hello, Sumit. Guys, we are just beginning with today's session. So, hi, Samuel. Good morning. Hello, Yogendra. So, good morning to all of you. Guys, as you all know, I'm your mentor, Mansi Anand, for RBI Grade B examination. Guys, I'm an alumni of Delhi School of Economics and a GRF holder in Commerce and Management. So, as you all know, in this session, we will discuss a few questions, and based on those questions, we are going to study some concepts, right? And these concepts, the conceptual clarity of these concepts is going to help you for your preparation for RBI Grade B examination, as it requires a lot of determination to clearing this exam, right? So many of you are here. So good morning to all of you. So guys, I think we should not waste time and move to today's session, right? So before moving to question number 1, I would like to ask you to subscribe to our channel, that is anujindal.in, and don't forget to press this bell icon, as it could help you to stay updated with a lot of information regarding different competitive exams, right? So guys, here is your question number 1 for the day. So this question says, which tool has been launched by RBI in December 2019 to stimulate the credit flow in the economy, as the transmission of rate cuts has been very slow. So guys, this is a question that relates to the current scenario of economy in India. So if you are reading the newspapers carefully, if you are updated with whatever is going on in the economy, then you must be knowing answer to this question, right? So let's see, answers have started to pop up. So guys, don't forget to take care about the dates that are mentioned in the questions, because sometimes there can be more than one answer, but these dates, they help you to decide which one should be the correct answer, right? So Prakash says C, Gaurav says B, Khushbu says C. Okay, many of you are saying Operation Twist, and there are some votes for LTROs. So waiting for your answers, guys. Then we would move to the solution and know about the answer. So Kanan says Operation Twist. Devinder Singh, he says LTROs. Gurpreet Sidhu, he says C. So guys, anyone else would like to answer, or should we move to the solution? So Binti Malik says C. So guys, are you ready for the solution? Or you would like to give some more answers? So I think the fight is between Operation Twist and long-term repo operations, right? Hello Lokesh, good morning. So guys, let's move to the solution and let's see what is the answer. So the answer to this question is Operation Twist. That is option C. So all those of you who answered as C are absolutely correct. So guys, I noticed that there have been confusions between LTROs and Operation Twist, right? But you have to take care that in December 2019, Operation Twist was conducted by RBI. LTRO is a more recent phenomena. LTRO was just conducted this month. In February, right? So that is why I told you have to look for the dates. They are very important because all these operations, all these are tools with RBI that it uses at different times according to different situations. But these dates, they help you to remember or help you to answer that what should be the correct option, right? So Operation Twist, I have been getting many doubts about Operation Twist because students are not clear that what is this tool, what is this going to do, and why has RBI conducted this. So in yesterday's session, Khushbu asked about Operation Twist. That is why we are studying Operation Twist here, right? So guys, before studying about Operation Twist, we have to be clear with some concepts. If we know about those concepts, only then we can understand this operation that has been undertaken by RBI, right? So now let's start with the solution of Operation Twist. So now let's decode Operation Twist. So guys, first of all, you have to be clear with the concept about bond prices and bond yields. So I hope you all know what bonds are. So all of you clear with what bonds are? So bonds are debt instruments that are issued by banks and companies and governments also to raise money, right? So there was also a doubt about the difference between bond and equity. Whenever a firm issues bonds, it means debt. And whenever it issues equity, it means ownership, right? So this is the main difference between bonds and equity, that bonds are less riskier assets and equity is riskier as compared to bonds, right? So here we are not talking about the bonds which are issued by corporates or which are issued by the banks. Here we are talking about the bonds that governments of different countries issue. So guys, why do you think a government needs to issue bond? So a government has lot of money. It gets lot of money through taxes. It has the option of deficit printing. It can just print out money anytime it wants. So why do you think it needs to issue bonds? So as Anil Kumar says, the bond is indebtedness of issuer to the holder, right? So government needs to issue bonds first of all to raise funds. So I know government has got a lot of resources, a lot of sources for collecting revenue, but it has also got a lot of expenditures. So government can raise money through bonds, and to all the investors who invest in these bonds, they get a fixed coupon payment known as interest. So this interest is the income for the bondholders, right? So now a bondholder, he or she can either retain the bond for a long time or sell the bond whenever that holder wants to, right? So there are two concepts here. A bond has a price and yield, right? So what is the price of a bond? The market rate or the money which an investor has to pay to acquire this investment opportunity or this bond, right? So that is the price of the bond. And what are yields? Yield is the earning that an investor earns on the bond. So guys, do you get the difference between price and yield? So price is an amount which an investor pays to acquire this bond. So let's say here is our friend Mr. A, and this Mr. A, he wants to invest some money. So what he does is he buys a bond. So now he has to pay some sort of money to acquire this bond, and this money that he pays will be known as the price, right? And now why is he investing his money into this bond? Because he is going to get some return out of it or some monetary benefit out of it, and that monetary payment, that reward, that return to this investor, to Mr. A, is known as yield. So what are the components of this yield? First of all, on this bond, this investor is going to get interest income. So guys, these bonds, they are accompanied with a rate of interest. So let's say if there is a 10% bond, that means 10% bonds per annum. So that means whatever the value of bond is, 10% of the value of this bond is paid to the bondholder as interest, right? Now, the second component of yield, what happens is, now this investor can pay this yield. Now this investor, Mr. A, our friend, he can sell this bond, and whenever he sells this bond, the price is going to be changed. It is not necessary that the price is the same as when he bought it. So if the price is more than what he bought it, let's say if he bought the bond at ₹1,000, and at the completion of 1 year, he gets 10% as interest income, that is ₹100, and when he tries to sell the bond after 1 year, he gets ₹1,100 after selling the bond, right? So you can see he has earned ₹100 as interest and ₹100 as yield, ₹100 as selling, as increase in selling price, right? So he has made two types of gains, right? So I hope we are clear till here and there are no doubts till here. So this is the first concept, which is regarding what are bonds, what are their yields, and what are the interest rates. So now, these two components of bonds, price and yield, they both are inversely related. Now, what does inversely related means? The relationship between both of them is like a seesaw. So what happens in a seesaw? When one goes up, the other one goes down. Same is the case with these two components, right? Whenever the price of the bond goes up, the yield goes down, and whenever the price goes down, the yields go up. And we are going to learn about the reason behind this inverse relationship. So I hope there are no doubts till now. So coming back to our friend Mr. A, this Mr. A has a bond, and on this bond he is getting a 10% interest, right? So now we are going to learn why is there an inverse relationship between price and yield. So now what happens is, the interest rate that is decided by government, because the government is issuing that bonds. Guys, remember here we are talking about the bonds that are issued by government, right? So government is issuing these bonds, that is why it can move the interest rates up or down, right? So now government raises the interest rate. Now the new bonds which government is issuing are at 12% of interest. So now this Mr. A, he wants to sell a bond which earns 10% income, but in market the new bonds that are being issued by government are at 12%. So now Mr. A talks to another person, his friend Mr. B. So Mr. A asks Mr. B to buy this bond which earns him 10% income annually. So what do you think would be a prudent decision for Mr. B? Buying the bond that his friend Mr. A is offering at 10% of interest rate, or buying a bond which government is offering at 12% of interest rate? So what do you think would be the decision of Mr. B? If you would have been in the place of Mr. B, what would you have done? Helping your friend by buying his bond, or buying the bond from government? Which would be more beneficial to Mr. B? So guys, I am waiting for your answers. Just think that what would be more beneficial. Mr. A is offering to Mr. B a bond that is earning 10% interest income, and government is providing a bond which is earning 12% interest income. So all of you say that Mr. B should go for government bonds and he should just forget about his friendship to Mr. A, right? So obviously this is the more prudent decision, as here he is getting more benefit, right? So now Mr. A, he is a very clever man. What he does is, he says that don't pay me rupees 1,000, pay me somewhat lesser amount than 1,000, that would compensate your monetary benefit that you are getting from government. So he bought a bond at rupees 1,000. Now he is offering to Mr. B at rupees 800. So guys, now do you notice that how to sell his bond? Mr. A has to reduce the price to compensate for the benefit that Mr. B is getting in government bonds. Right? So I know this is a little bit tricky concept, but if you pay attention and think about it carefully, you will definitely get it, that how to sell this bond. Because of the increased interest rate, Mr. A has to reduce the price of his bond. Now Mr. B thinks that it might benefit him to buy the bond at 800, earn the interest income of 10%, and after that sell the bond, right? So now do you see how when interest rates rise, you see how it was earlier 10%, it rose to 12%, but the price of the bond, which was at rupees 1,000, it had to go down to 800. So this is how an inverse relationship works between bond yields and bond prices. So I hope you are clear with this concept. Are there any doubt? If there are any doubts, guys, you can ask straight away. So this inverse relationship, it also works in the opposite direction. If this interest rate that was earlier at 10%, it will go down to, let's say, 8%. Now what do you think, what would be the decision of Mr. B? Would he like to buy the bond that Mr. A is offering, or would he like to buy the bond that government is offering at 8%? So guys, just think carefully. Now the interest rates, instead of going up, they have gone down. Earlier it was 10, now it has become 8. Now what do you think, what would be the more profitable opportunity for B? Either to buy a bond at 10% that his friend is offering, or buy a bond that earns him 8% interest income that is being offered by government. So you can see how there is higher income in going for option A that Mr. A is offering, right? But now Mr. A, as I told you, he is a very clever man. Now he says, I am not going to sell you this bond, as this is earning more benefit, more income than the market. That is why if you want to buy this bond, you will have to pay me rupees 1,200. So now an inverse relationship also works here. The interests, they go down, and the price of the bond, it goes up from 1,000 to rupees 1,200. Yes, Venkatesh, you guessed it right. Mr. A is going to raise the price of the bond. So guys, now I hope we are clear with our first concept, that how an inverse relationship it works between the price of a bond and the yields that are earned by the bond. So if the interest rate goes down, the prices go up, and if the interest rates go up, the prices go down. So are there any doubts regarding this? So Rupesh is asking that why does he bear loss? So Rupesh, are you asking about Mr. A or Mr. B? I'm sorry, I'm not able to get your question clearly. Could you mention it again in a more clear form? So Rupesh is asking Mr. A, why would he bear loss? So you are asking in first case. So in first case, the interest rates, they went up to 12%. So why would he have to bear the loss, right? So Rupesh, let's start again. The interest rates earlier, they were 10%, right? But the government raised it to 12%. Now, it would be very difficult for Mr. A to sell this bond in market, because the other bonds that are being sold in market, they are earning higher interest income that the bond that this person has, that Mr. A has. So Mr. A has a bond that earns 10% income, whereas the government bond is providing 12% interest income. So do you see how it is less beneficial for any investor to buy Mr. A's bond? And if Mr. A wants to sell his bond, he will have to reduce the price. So let's say if you want to sell a house, right, in market. So market price of that house is 50 lakhs. But now the buyer, he discovers that there is some sort of problem with the property. There is a legal dispute which is going on with the property, and now the buyer does not want to buy this house. Now what would a seller do? When there is a defect in the product, what does the seller do? He tries to reduce the price of the product so that the buyer buys it and gets compensated for the loss. So that is why Mr. A will have to reduce the price. So now are you clear, Rupesh? So guys, in this video, we are just going to learn about the basics of operation twist, because it's a very complex concept. It takes a lot of reading to understand it. That is why in this video, we will only discuss the basics of it. We will learn about different aspects of this tool in our further sessions, right? So don't burden yourself with too much information. Just try to get the concepts right. Then you can learn more about this. So Souvik, if you want to learn about these informations, you have to read the newspaper carefully, check the RBI website. You're going to get all the information regarding this, right? So guys, now we are clear with two things. First of all, bond yields and bond prices. So these two components of bonds, they are inversely related, right? So this is our first concept. Now moving on to another concept about the current scenario of Indian economy. So guys, as we have been discussing in our previous sessions, that the credit flow in India is very slow. In today's times, businesses are not willing to invest the money in riskier opportunities. That is why credit is not taking place, right? Businesses don't want to invest. They are scared of the market situations, be it the spread of coronavirus or the global slowdown. That is why they are not investing. And the public, they don't want to spend the money, right? So RBI wants to stimulate this credit flow. And what has RBI been doing? Since January 2019, it has been trying to lower the interest rates, which is a very common tool. Whenever a central bank wants to stimulate the economy, what does it do? It lowers the interest rate so that borrowing costs are less and businesses invest and results in wealth creation, right? But the problem with lowering the interest rates is the rate cuts, the transmission of rate cuts is not going to the customer, right? So let's learn about transmission. So guys, look carefully. There are two tankers. One is filled with water, and these two tankers, they are connected with a pipe, right? So whenever we want to transfer water from tanker 1 to tanker 2, what happens is water flows through this pipe and reaches this tanker 2. So we can recreate this logic in our Indian economy. This tanker 1 is RBI and it is trying to transfer the water. Water is the credit flow. So it wants to transfer this credit flow into tanker 2, that is the market, or you can say economy. And how does it do it? Through this pipe, and these pipes are known as banks. Right? So this is the mechanism that takes place commonly. But what happens if there is a crack in this pipe? All the water that tanker 1 will transfer, it will leak through this hole and it will not reach market or tanker 2, right? So this is what is happening in current economic situation. RBI is cutting the policy rates since January 2019. It has cut the rate about 135 basis points. But the benefit is not reaching the market. And why is that so? Because banks are not lowering their interest rates. So there is a hole in the pipe, or there is a fault with banks that they are not lowering the interest rates. That is why RBI is not able to stimulate the economy with the help of lowering of policy rates, right? So that is why it has resorted to Operation Twist. So guys, this analogy has been given by Mr. Raghuram Rajan, the former governor of RBI. So I hope you are clear with this concept that why lowering of policy rates is not working in Indian economy. Right? So now what RBI is doing, it has resorted to Operation Twist. Now coming back to our main topic or the elephant in the room, that is Operation Twist, right? So guys, I'm going to give you a few seconds to interpret all this information, then we will start with the main mechanism of Operation Twist. So I know it's a very complex concept, but if you will pay attention, then you will be able to learn about it. So guys, now moving on to the Operation Twist as we are short of time. So under Operation Twist, RBI is going to do two things. That is, first of all, buy the long-term bonds and simultaneously sell the short-term bonds. So guys, we just learned that there is an inverse relationship between the price of bond and the interest rates, right? So what will happen if RBI will buy long-term bonds? The demand for long-term bonds will go up, and when the demand for these bonds will go up, what will happen? The prices will go up. And if the prices will go up, what will happen with the yield? The yield will come down, right? And if it is selling short-term bonds, what would happen? The demand for these short-term bonds, it is going to get reduced, and the price is also going to get reduced, right? And what will happen with the yields? The yields will go up, right? So guys, now do you see how yields in long-term market are going to get reduced whereas the yields in short term market, they are going to get increased. So now what will happen is it would be more beneficial for investors to buy long term or take long term loans, because the interest rates in the long term markets have gone down. That is why businesses would like to invest for long term. They would like to take long term loans rather than taking short term credits, right? So this would stimulate the credit flow in the economy and transfer the funds from short term market to long term markets. And as credit flow will stimulate in economy, the economy will get started up with all the consumption that has been lacking in the previous year, right? So now I hope we are clear with the operation twist. So I told you it is a very complex concept. So guys, if you have any doubts regarding this concept, you can mention in the comments and we will take up them in different sessions. Now moving on to the second question. So this is your second question for the day, which talks about liberalized remittance scheme. So all the resident individuals, including minors, are allowed to freely remit up to USD dash per financial year for any permissible current or capital account transaction or a combination of both. So I'm waiting for your answers. So Vishal, don't worry, we are going to cut the explanation short for the rest of the questions. They do not require much explanation. So that is why we can cover them in short time. So Rajat says E. Venkatesh says 2 lakh. Whereas Shubham says C. Chandan also says E. So guys, since most of you say E, most of you are right, because the correct option is E. So guys, this is a scheme which allows all the resident individuals who are in foreign and they want to remit some money into their domestic country. So this schemes allows them to transfer an amount equal to USD 2,50,000 per year, right? So this scheme was started in February 2004. So it is a very simple question. It does not require much explanation, as this is a scheme that allows resident individuals to transfer money. It can be in current account or capital account or a combination of both, right? So guys, if you remember in a previous session, we learned about how Mauritius is not an FATF member. That is why the investments coming into India through Mauritius are now being routed through Singapore, as it does not enjoy the exemptions as it did earlier, right? So now what government of India did, it allowed the investments coming from Mauritius to register as FPI, because Mauritius is a big source of investments in India, right? It is the it was in 2019, it was the second biggest investor in FPI in India after the US. So that is why the investments from Mauritius are allowed in India, and that is why this scheme is also permitted from Mauritius. Otherwise, it would have been very difficult if Mauritius was not allowed to register as FPI, right? So it's a very simple question. Now moving on to the next question. So this is your third question for the day, and it says, how does Indian government bonds getting listed in global indices prevent crowding out of the private players? So guys, here you need to know about the concept of crowding out, right? So I'm waiting for your answers. So Ankur, we can take the currency swaps in next or the forthcoming sessions, as we are already short of time here. So guys, I'm waiting for your answers. Read the options carefully and then try to answer the question. So we have got a first answer, that is E. Guys, I'm waiting for your answers. It's a very simple question. does not require much thinking, only knowing what crowding out means. Are there more answers? We have got only one answer for this question, guys. If you know the answer to this question, you should mention in the comments. It's a very simple question. You just have to know what crowding out means. Also, we discussed in our previous session about how RBI is trying to get Indian government bonds listed in global indices. So we have got more answers. Khushbu and Rajat say B. Samuel says B. Anyone else? So Sumit says B. Since most of you say B, let's see what the correct answer is. The correct answer is, guys, A. So guys, first of all, you have got to read the questions carefully. So what does crowding out means? First of all, we have to understand that what does crowding out means. Crowding out means that whenever governments and large governments like India or US, they borrow, what happens? So when they borrow, there is an increased demand for money in the market, and if there is an increased demand for money in the market, what will happen? Interest rates will go up. So these increased interest rates, they would disincentivize the private sector to invest, because if government is borrowing the money, there is less money available for the private sector to invest. So you see how if government is borrowing money, there is lesser money, lesser funds available for the private sector. So you can understand with the help of this example. If there is a pizza and it has got 8 pieces. Now, earlier the government was having 2 pieces of it and 6 pieces were available for the private sector. Now, since government wants more, it wants to borrow more, it is having 4 pieces of this pizza. Now, only 4 pieces are left for the private sector. So, do you see how an increase in borrowing by government reduces the share available for the private sector? That is why the private sector gets crowded out or private sector gets left out, and the interest rates are increased because of increased borrowing by government. So that is why the correct option is option A, which says if Indian government bonds are listed in global indices, it would attract foreign investments. So you see how if Indian governments will get listed in the foreign indices, they will attract foreign investment and they will not require the money from India. So the money available in India would be available for private sector, and private sector would get more money, right? So I hope we are clear with this question, that how does government bonds listing in global indices, it prevents crowding out of private players. So the private players, they are not getting crowded out, as more money, more funds are available for them, as the government is borrowing from foreign, not from India, right? So are there any doubts about this question? It's a very simple question if you know the meaning of crowding out. So guys, before moving to next question, I would like to tell you that we have a Telegram group, and by joining this group, you can ask your doubts on this Telegram group, which can be resolved very easily. That is why you should join this Telegram group. It can be really beneficial for you. So the next question, guys, the next question says, what is the name of amnesty scheme launched by government to address the problems of low tax collections? So it is a very recent happening in Indian taxation structure. So the government wants to resolve the problem of less tax collections. That is why it has come up with a scheme in this budget, and you have to tell what is the name of that scheme. So Khushbu says D, that is Vivad se Vishwas Tak. So let's wait for more answers, Khushbu. So most of you say D. So guys, you are absolutely right because the correct answer is D. That is Vivad se Vishwas tak. Right, moving on to the solution for this question. So guys, this scheme is inspired by an earlier scheme which was launched last year in last budget, that was known as Sabka Vishwas scheme. So under this scheme, what government is doing, it is telling all the individuals, all the taxpayers that if you will pay your taxes before March 31, 2020, all the interest and penalties that were due on your payments, they would not be charged. So you see how taxpayers are getting a benefit because they would not have to pay interest and penalties if they pay before March 31, 2020, right? So this is the scheme and the objective is to collect taxes at the same time reduce litigation. Why reduce litigation? Because the government or the authorities would not have to do much work if people are popping up and paying their taxes. Right? So there are more benefits that you can learn about if you study this scheme that are being provided to the taxpayers. So guys, moving on to the last question for this session, which says, in case of telecom companies, as per government, what is included in the calculation of adjusted gross revenue or the AGR? So guys, we have already discussed in detail that what is the AGR issues that have been going on in telecom industry in India. Now this question asks you that what is included in the calculation of adjusted gross revenue as per government. So guys, as per government is the key word because telecom industries, they want to calculate it their own way. But according to government, what components should be included in the calculation of AGR? So Nilesh says C. Venkatesh says E. Shubham says C. Mahalakshmi says E. So guys, I'm sorry to tell you, but you're not getting the correct answers. So Siddharth says all the above. So Siddharth, you actually have to tell what option out of these 5 options. So Prakash says A and Vishal says E. So guys, the correct option for this question is E is not correct. The correct option is A. That is all the components. So I already told you in a session when we discussed about the telecom sector and the AGR issues that government wants telecom companies should calculate the revenue as all the incomes that they are earning. It can be non-core incomes or it can be income from core services that are providing calling services and broadband services. So that is why as per government, every component should be included to calculate AGR or adjusted gross revenue. So I hope we are clear with this solution, guys. So are there any doubts in the questions that were discussed in today's session? So I don't see any doubts popping up. So guys, I hope that we all are clear with this question. And thank you for being here. Thank you for watching this session. I hope you get to learn something new every time we do this session. So guys, if you have learned anything new from this session, then do hit the like button and subscribe to our channel, and we'll be back with such sessions and more videos to help you with your preparations. So all the best for your exams, prepare well, and we'll meet tomorrow at the same time. Thank you for watching.